Imagine, just for a second, managing your entire financial life without ever interacting with a traditional bank. Sending money overseas to family, getting paid by an employer, or storing your life savings. And doing it all instantly, across borders, 24/7, without ever worrying about business hours. You just open a digital wallet on your phone, holding digital money that's actually designed to stay perfectly stable. That is the utopian promise of stablecoins. It's this idea of a completely frictionless financial world. But it brings us to a massive, multi-trillion-dollar question. Could this technology realistically step up and completely replace the traditional banking system? Okay, let's dive right into this, because the answer isn't just a simple yes or no. You see, stablecoins absolutely have the power to completely transform certain parts of banking, especially when we're talking about simply moving money from point A to point B. They are a massive disruptor there. But as we all know, banks do so much more than just transfer our funds. The real question we're exploring in this explainer is whether stablecoins are going to fundamentally change what banks actually are at their core. First things first, let's make sure we're on the same page with our terms. When a lot of people hear crypto, they immediately think of those wild roller coaster price swings. That's your standard, highly speculative cryptocurrency, the kind of asset that can literally lose 10% of its value while you're asleep. A stablecoin is entirely different. It's a digital asset specifically engineered to maintain a predictable, stable value, usually by pegging it directly to something like the US dollar. It's exactly that unique combination, the lightning speed of crypto paired with the boring, reliable stability of a regular dollar, that makes stablecoins so incredibly appealing for everyday, real-world use. Now, why does that stability actually matter so much? Well, just think about how ridiculously clunky traditional international money transfers are today. When you try to send money across borders, it doesn't just magically teleport to the recipient. Oh no, it bounces from your local bank, gets tangled up in clearing systems, hops across multiple international correspondent banks, and then usually takes a hit from a currency conversion. It's literally a decades-old obstacle course filled with hidden fees and frustrating delays. Enter blockchain technology. Blockchain basically bulldozes that entire obstacle course. Because stablecoins live on a shared global network, your digital wallet connects directly to the recipient's wallet, no matter where they are in the world. You can send a stablecoin across the planet in seconds, completely skipping the middlemen. Now, to be fair, it's not always 100% free. You do still need services to get your regular money in and out of the digital ecosystem, but it introduces a radically streamlined, frictionless way to move value globally. And honestly, it gets even better. Because stablecoins run on blockchain infrastructure, they unlock something called programmable money. This is where it gets a bit sci-fi, but it's happening right now. Imagine a payment that literally executes itself based on built-in rules. A supplier gets paid the exact second a delivery barcode is scanned at a warehouse. Or a freelancer's funds automatically unlock the moment a client approves their project. Blockchain makes this automation a native feature of the money itself, stripping out the need for human intervention entirely. It's pretty amazing. Which naturally leads us to a very logical, curiosity-driven question. But if stablecoins are so insanely efficient, if they bypass all those intermediaries and can act as self-executing programmable money, why on earth do we still need traditional banks? And right here, this is our reality check. Because to truly understand the future of global finance, we have to shift our perspective away from just moving money and look at the heavy, complex realities of what makes the global economy actually function day to day. Now, what's really fascinating here is just how massive and deeply rooted the traditional banking ecosystem actually is. Banks are not just glorified digital wallets. They accept our deposits, sure, but they also evaluate complex credit risks. They inject absolutely essential liquidity into financial markets, and they provide the massive loans required to keep businesses running and growing. And they do all of this under incredibly strict, complex regulatory guardrails. So, a digital wallet holding a stablecoin, it barely scratches the surface of what global finance actually requires to function. It basically boils down to this fundamental difference. Banks equal credit creation. Stablecoins equal payment mechanisms. A traditional bank takes your deposits, uses its balance sheet, and issues loans to drive economic growth. Holding a stablecoin in an app doesn't automatically create a loan for someone else to buy a house or start a business. So, replacing banks wouldn't just mean upgrading to a fancier payment app. It would mean completely rebuilding the entire global credit system from scratch. We also have to talk about risk, because, spoiler alert, stablecoins absolutely do not eliminate financial risk. They really just change its flavor. Look, traditional banks face bank runs. We've seen it happen. But they usually have government deposit insurance to catch you if things fall apart. Stablecoins, on the other hand, face what are called redemption runs. If users get spooked and try to cash out all at once, you're relying entirely on the private issuer's reserves being fully stocked, usually without any kind of government safety net to bail you out. And without that government safety net, trust becomes literally everything. You have to ask, what is actually backing that digital dollar? Some stablecoins are backed one-to-one by actual cold hard cash sitting in a bank vault. Others rely on really complex algorithms or other crypto assets as collateral. If a token claims to be worth exactly $1, you need absolute, undeniable proof that the money is actually there to cover it. That's why extreme transparency regarding governance and reserve assets is the only way a stablecoin survives in the long run. We also need to completely shatter this illusion that digital somehow automatically equals safer. Blockchains introduce entirely new nightmares. A tiny, overlooked flaw in a smart contract code can drain millions of dollars in a matter of seconds. And remember, there's no 1-800 customer service number to call if you accidentally lose your private keys. Your money is just gone forever. No do-overs. Throw in looming regulatory crackdowns and sophisticated cyber threats, and you quickly realize this digital frontier is anything but risk-free. And because of all these risks, and honestly the sheer, staggering scale of this technology, governments aren't just sitting on the sidelines. Enter CBDCs, or central bank digital currencies. Governments realize that if privately issued stablecoins become too dominant, central banks could actually lose their grip on the economy and monetary policy, like controlling interest rates. So many are building their own digital money. What we're watching right now is a brewing, high-stakes battle between private tech innovation on one side and government monetary control on the other. Depending on who actually wins that tug of war, we could be looking at the emergence of a true parallel banking system. Try to picture it. Millions of people holding stablecoins, regular businesses accepting them for coffee or rent, and entire online economies running strictly on crypto rails. It becomes this massive, alternate financial universe operating right alongside our current one. But here is the critical catch you need to remember. Even if this parallel universe takes over, traditional banks are still not going to just vanish. So the crucial point we need to take away from this explainer is this. The most likely reality of our financial future isn't stablecoins versus banks. It's a hybrid future, stablecoins plus banks. Stablecoins are absolutely going to modernize the underlying plumbing of finance. We'll likely see a world where you can seamlessly move value between your old school bank account and a next-gen digital wallet. Banks themselves will probably use blockchain on their back end to save billions in operational costs, all while fiercely protecting their highly profitable lending and credit businesses on the front end. In this hybrid setup, banks survive and thrive by doing the heavy, unglamorous lifting that blockchains simply can't do. They are going to be the secure, highly regulated bridge between traditional fiat money and digital assets. They will handle the massive burden of regulatory compliance, they'll act as trusted custodians for institutional assets, and they'll continue to issue the credit that powers our actual physical economy. The bank of the future might become completely invisible to everyday consumers like you and me, acting as the silent regulatory backbone supporting all those instant, frictionless apps on our phones. There's a quote from the research for this explainer that I think perfectly hits the nail on the head. Replacing banks would require much more than replacing payment systems. It would require recreating the entire credit system. Moving value quickly and cheaply is a brilliant, necessary technological solution, but allocating credit, managing complex human risk, and providing broad economic stability, that is a fundamentally human institutional problem. And at the end of the day, that is what banking truly is. So we're left with this really fascinating paradox. Stablecoins are incredibly fast, highly accessible, and they are completely changing how we think about moving money globally. But as this amazing tech takes over the payment layer, actual banking may simply sink beneath the surface, operating out of sight. So the question to leave you with is this. Are you ready for a financial future where money moves instantly and banks are practically invisible, yet remain totally essential?